Hello and welcome. Let's continue our series of the concepts behind previous year questions. This time we are discussing a question from the year 2013. Let's see what the question is. Economic growth in country X will necessarily have to occur. So basically it says that in a country, any country X, suppose ABC, suppose India. Why not? Why shouldn't we take this to be India? Let's say, when would economic growth in India occur? That's the question. That's the question. So if it says when it would necessarily occur, it would surely occur that in India's case, India's GDP would surely increase when? If there is technical progress in the world. So if there is improvement in Japan, if there is improvement in Taiwan, South Korea, China, US, that is, if there is a technological progress in the whole world, will it surely have an impact on India? Not necessarily. They may give us that technology, they may not give us that technology, right? So this is not the right option, because if there is a technological progress in these countries or say in the world, it will not surely or necessarily translate into a growth for India also. Let's look at the second option. There is population growth in India. If India's population grows as the population grew in India from 1921 to 1951, not in 1951 to 1980s. So if a country's population is increasing, but if that population doesn't have skill, if the population is not healthy, if the population is not educated, then that population will not have any positive impact on the GDP. It may rather act to be a demographic disaster for the country, because we need to produce also, we need to have that much of agriculture production that we are able to feed the increased population. So if population is increasing, will the GDP surely increase? No, not necessarily. This is also not the right option. There is capital formation in X. We'll look upon this option later on. The last is the volume of trade grows in the world economy. So if China trades more with US, if Japan trades more with US, if European countries trade more with India, if European countries they trade more with US, will it increase India's GDP? How will it increase India's GDP? Even the option is like sort of ridiculous, right? We can directly negate this. So now this is not going to happen. So now let's see what is this. There is capital formation in X. What is capital formation? Look, if you have known GDP by expenditure method, in GDP expenditure method, the formula is GDP is equal to C plus I plus G plus X minus M. C is consumption, I is investment, G is government expenditure on purchase of goods and services, exports and imports. When I say I, this I is actually the gross capital formation, GCF. This is called GCF, gross capital formation, which includes expenditure on purchase of machineries and equipments, expenditure on infra creation by the private entities. Expenditure on infra creation by private entities means creation of new buildings, new industries. Expenditure on infra creation by the government. For example, if government creates more of roads, airports, railways, that is called infra creation, that is capital formation. If there is capital formation in the country, that time, at that particular point of time, there is income for the people. Because if government is constructing roads, railways, ports, airports, if a private company is setting up industries, that would surely lead to that particular point of movement, the GDP would increase. At the same time, the increased capital formation would lead to further increase in production. If there is increase in like more of railways, roads, airports, bridges, the GDP would be coming up, because later on the private investment would be increasing, new factories would be coming up. So if there is capital formation in the country, if there is investment in the country, then the GDP of the country would necessarily increase. So in this topic, in this question we have discussed two concepts. One is, what's the formula of GDP by expenditure method? It is equal to GDP is equal to C plus I plus G plus X minus M. At the same time, what is I called? I is called gross capital formation. Gross capital formation, it includes expenditure on machinery and equipment. It includes government expenditure on infra creation, that is government expenditure on infra creation, then even private expenditure on infra creation, then residential construction, that also is included in gross capital formation, then expenditure on precious stones and gems, precious stones, precious metals, and last is inventory investment. I am writing it II. Inventory investment, which is also called as change in stocks. So all six, they comprise gross capital formation, and out of these six, these top four, expenditure on machinery and equipment, infrastructure by government, private expenditure on infra creation, and residential construction, as these four things are stationary, as these four things are fixed, these four are also called as GFCF, that is gross fixed capital formation. Now, this GFCF, it comprises 95% of gross capital formation. That is, if in 1 year we are spending 100 rupees on these six, out of those 100, 90 to 95 is being spent on GFCF. So generally, investment in the country is also read as synonymous with investment. Investment in the country is read synonymously with gross fixed capital formation, or GFCF. Alright, I hope you have discussed what is, I hope you have understood what exactly is GDP by expenditure method, the formula, and what exactly is gross capital formation and what is gross fixed capital formation. That's it for today's question. We'll continue. Alright, thank you.